In this video, we have some exciting Lemonade content for you guys. We're going to look at a Lemonade projection model through to 2030, my model that I've put together. And we're also going to look at part of that is we're going to look at Lemonade's cash runway. If you get value out of this, make sure you hit that subscribe button down below and hit that thumbs up, that like button while you're at it. It really does help. I also have a Patreon. If you'd like to join my Patreon and support the channel, feel free to check out the link in the description. Okay, so let's dive into the model. And to be absolutely clear, this is one possible model. There's a lot of uncertainty when you're trying to, there's a lot of assumptions and a lot of uncertainty when you're trying to model out the future, what the future could look like for a high growth company like Lemonade. This could obviously, a lot of the assumptions you have to make in order to make a model like this could pan out either to the upside or the downside and could have huge, significant results or impact on what the future of the company holds. So this is just one such model, still a work in progress, still something I will be refining over time and certainly quarter by quarter updating and reviewing with you guys as Lemonade's story progresses. So we'll walk through just first off what from top to bottom, what this model kind of looks like. The red line here is historic quarters, and to the right side of the red line is future quarters, projected quarters. So if we look at Q1 of 2022, when I have a couple years here of history going backwards, and then a number of years going forwards all the way to 2030. So if we're going to just walk through Q1 of 2022 and this next quarter of this year, Q2 of 2022, top here we have customers of 1.5 million. And we have a customer percent change. I do show the percent change growth here, this top line growth for this metric. And then you get, and then you have how much customers are growing on a quarter over quarter basis. So they grew 5.4%, 77,000 customers they added, and they got to 1.504 million customers over 1.427. Premium per customer, we're at $279 per customer. That also I have the percentage, quarter over quarter percent change. So we're at 4.9%. And then you get your in-force premium, which is of course just your number of total customers times by your premium per customer. You have $420 million of in-force premium. Then I have gross earned premium as a fraction of in-force premium. Because remember, in-force premium is all the premium of every single policy in force at any given moment. So at the end of each quarter here, they would count all the premium they have in force. That's your in-force premium. And then gross earned premium is how much premium in that quarter can ended its term. So you have maybe a policy is on a 12-month basis. Somebody has a policy with renter's insurance with Lemonade on a 12-month basis. At the end of that 12 months, when that's completed, then it would change to gross earned premium, that whole contract. So it makes sense. It's roughly about 25% or approaching 25% of in-force premium, but I get this number just so that I can project into the future at least some kind of value of how gross earned premium, what percentage of your in-force premium is going to be gross earned premium going into the future. And then going down here, we get into our reinsurance section here. They're at about 72% reinsurance. So I've put how much of their premium is being covered by or being shifted to reinsurance. And so you get a percentage of your premium here, your gross earned premium, that is ceded based on your reinsurance amount. So that amount is ceded to reinsurance. And then you have your leftover amount, which is what's left over for Lemonade. And then you have a ceded commission. And I've just put in 25% going forward. This could change, obviously, but this would be structured into their reinsurance agreement. They have 25% of what is ceded to the reinsurers. They get back kind of added as an administration fee. So they get they get 25%. That's their commission income, is that commission back on what was ceded. So Lemonade also takes that. And so then you get a total of the reinsurer's total income, $52 million, and then Lemonade's total revenue, about $44 million. Then you're moving down You have a gross loss ratio. Their loss ratio was about 90% last quarter. And and then I'm trying to project that into the future, maybe 85% the next quarter. And you have your insurance losses, total insurance losses, which is just going to be your full gross earned premium for the quarter times by your gross loss ratio for the quarter. Oh, hold on here. And gets you total insurance losses. And then you have the percentage that's covered by reinsurance of those losses, and then the percent or the amount, the remainder covered by LMND. So you have your profit after insurance losses is about $20 million. After they've paid out what is covered by reinsurance and then paid their portion of the losses, they have about $20 million left over. Then we get into, sort of their operating expenses. And first of all, this section has to do just with their marketing. So I have their annual dollar retention. When I have done a marketing video on this, another tab up here, it kind of shows it as well from that video. But you can calculate their churn on a 12-month basis from their annual dollar retention. Annual dollar retention, basically what percentage of dollars, if you look at a certain cohort of customers from 12 months prior, so 12 months, say Q1 of 2021, if you look at all those customers that were there at the start, and then all of those same customers at the end now, how much money they had in premiums then back in Q1 of 2021 now to Q1 of 2022, it's 82% of those dollars are still in premium. Now, the crazy thing is their premium per customer is changing. It's rising, but their amount of customers is dropping as there's a certain amount churning. So you can kind of sort that out. I've done that math, and then you get the amount of customers that are churning, and you get about 359,000 customers from 12 months prior, which is the percentage of those customers is about 33%. So we're in these 30% range. It's a pretty high amount. And you get then a cost, an acquisition cost per customer of about based on, I had $229 last quarter, but this is actually based on all the new customers plus the customers that churned. So I actually kind of want to know on just not on a net customer basis, but on a churn customer basis, every new customer that you add, how much are you kind of paying? If it was on a net customer basis, of course, they would have spent the same $38 million in sales and marketing, but they would have got less customers on a net customer basis, so this number would be quite a bit higher. But on a every single customer, even the ones that came and then left, or even including the ones you made up for, the customers that churned, I should say, then you get this value of $229. And I'm just going to flip over to the sheet really briefly to touch on this. I did show this in this other sheet here. We had $230 from last quarter. But going back to Q3 of 2019, we have this churned customer churn acquisition costs with the churn customers included in there, and you get an average of about $183 per customer. So anyways, that's an important number just to sort of think about how much are you actually going to pay for every new customer that's joining. So anyways, then you get your sales and marketing total, and then also have other insurance expenses. You also have technology and development expenses, general administrative expenses, and then I have total operating losses, which just includes all these three plus also your sales and marketing. And then I've taken my operating income and calculated that just from your profit after insurance losses here, that 20 million minus your operating expenses. So they lose around 70 million. This is not exact accounting. If you look at their quarterly reports, it's going to be slightly different numbers, but this is pretty close, and I think close enough for when you're trying to evaluate a company like this, like Lemonade, where you're making so many big assumptions going into the future. This I think is close enough, and we have about just over $1 billion in cash on hand. And then I also put in here a cash requirement. See, the way Lemonade's reinsurance is structured right now, they need about 1/7 of every in-force. Basically, for every dollar they have, or every $7, I should say, of in-force premium that they have, for every $7 here, they need about $1 in cash and cash assets or liquid assets. So I've taken the in-force premium total, which is up here, your $420 million, and divided it by 7 to get about $60 million is their cash requirement. So very, very healthy. No risk of even getting close to that number at this point in time. But obviously, we'll see as we go forward how that could kind of play out. And then as we get into some later years, I'm also going to look at two different ways we could maybe look at the what the market cap or valuation of Lemonade could be. So now I'm going to kind of look left to right from here to 2030. Through each of these sections here, and that will kind of walk us through the entirety of the spreadsheet. So I'm projecting about 4% maybe next quarter in quarter-over-quarter growth for customers. In this quarter, I actually added an extra 100,000. So I said about 6% growth, organic growth, plus another 100,000 from customers from the Metro Mile acquisition. So you get a big bump from. You add 193,000 customers in Q3 versus maybe a 60,000, 70,000 customer add other quarters. And then I'm projecting about, again, 6%. Going into next year, we're at about 8%, 8%, 8%, 8%, 8%, 8%, 8%. And if you think about it, what's 8% quarter over quarter? So you just go 8% to the power of 4 quarters. You're at about a 36% annual growth rate. So, yeah, and that's about, they've been like as high as 40%, 30% in that range for customer growth. I do expect they could sustain that kind of growth for a long time, especially as they have more of as their product, sort of full suite of products rolls out to everyone who might want them, especially auto insurance, car insurance is a big one that a lot of people would want. Then that's going to, it could be easier, I think, to actually attract more customers because they have more comprehensive suite. You got your home insurance, you get your pet insurance, you get your car insurance, all from Lemonade, all in one stop, one shop. So I'm projecting 8% or 36% kind of annual growth if you look at 8% over several years. So if I just keep extending that out, I don't think this is totally unreasonable. You get to the end of 2030, you could be at maybe 22 million customers, 20 million customers plus. You think about just the size of their ambitions. That's over 8 years away. That's a ton of growth, but I don't think impossible. Certainly, again, you have to make huge assumptions. This could be totally wrong, but this is, don't think impossible. And again, this spreadsheet, this projection will be evolving over time. Just know it's not perfect, work in progress here, but it will be evolving over time. But I think this is not unreasonable also. Okay. And your premium per customer, I'm thinking it's going to have a big shot up. You could have a big jump here just as a lot of people could, a lot of new Metro Mile customers that are at more like an $1,100, $1,200 per customer rate. Those 100,000 customers are going to be added into this pool. Plus, also more customers should be again bundling and adding more products such as car insurance, which is going to be a bigger ticket item. So this could really push this premium per customer up, I think, in the next few years pretty significantly. So I'm projecting and then 9%, 12%. Quarter over quarter, 15, 15, 15. So some big jumps there where you get up to like maybe the $600 range. And then if you just keep going forward into 2024, 2025, I have 7% over quarter, 5% until you get kind of that $1,000 range. That's where, if you look at Metro Mile, I think they're at about $1,200 per customer, I think is what the numbers are for Metro Miles right now, their premium per customer. And they're just, only car. So obviously it really depends on how they grow. Do they continue to push into renters? Then they might even have, maybe their customer growth is higher, but their premium per customer mix is actually lower. So it's very difficult to kind of say how it's going to be balanced, but this is one such scenario. And maybe I continue pushing that out. I mean, most people have a car, and so you think if they have Lemonade, they could have other products with it. So I don't think it's unreasonable to think their premium per customer could grow to $1,000 plus on a sort of average customer basis. And that's kind of what I'm doing. It gets to 1,100, 1,200, and I kind of drop it off. No more growth, at least on the last few years. Obviously, that could be changing, could be even dropping if they're moving into new countries and there's just renters there and they don't have auto insurance yet. But this is one such scenario. You get to that $1,200 mark, and it's more of a flat line around that point. So that gets you, your premium per customer growth, covered that. And then, of course, your in-force premium, then you look at those two values, going from $420 million now for, maybe $665 million at the end of this year, all the way to, by 2030, you're talking, you potentially could be at, 20 some billion dollars in in-force premium, somewhere in that range. Gross earned premium, I've continued to keep this at 23%, kind of as they're continuing to grow the amount that's being flipped to gross earned premium each quarter. I kept their reinsurance so far all the way through at 72%. All the way through. I think Lemonade will continue to use reinsurance for a long time, foreseeable future, simply because by having reinsurance, the capital requirements, how much cash they need, the 1/7 of their in-force premium is significantly lower, and so it's really in their favor for a company that wants to continue to grow. And even at 2030, we're only talking 20 million customers. In theory, they could have significantly more customers than that if their product is superior, if their whole system is superior. Continue growing that into the future. So I've kept that all the way through, that 72%. And I've also kept the ceding commission at 25% all the way through. That, again, those numbers could change. Again, lots of sort of levers here you could push up or down one way or the other, and really could affect this model. So again, it's still a work in progress, something that will be evolving over time. Gross loss ratio, I'm hoping that can come down 85% and then slowly come down. Obviously, there's going to be some quarters, like maybe a catastrophe happens and this is 95%, but I'm hoping that can come all the way down, and then I have it at 75% all the way through. So, and hopefully they could get even lower than 75% as certain product lines mature. But I'm keeping it there at that level. Annual dollar retention, I have increasing as Lemonade Car rolls out, because in theory, a bigger ticket item like car rolls out, more people are more satisfied with the whole ecosystem. They don't choose to change their insurance provider. So your dollars that are being retained through a cohort, including changes in number of people, changes in premium or number of policies through that cohort of people, that should increase, especially the next few years. So I have that increasing all the way up to about 95, 100% even by 2024. I think there was some data I remember reading that said I think it was in Illinois for the annual dollar retention was more like 90% where car was. So I'm hoping that can continue increasing as more and more people adopt car, so that all the annual dollar retention is increasing. You still can have a churn, on a 12-month basis. Your churn is still 39%, still in the 30% range. But then I have the annual dollar retention lowering as the premium per customer higher up starts to drop. And then your churn on a 12-month basis is also dropping during that time. So even though this is dropping, but because then just the way the math works out, because your premium per customer is not changing as much, then this has less effect. It means there must be less people also churning. So anyways, I projected all the way that out to, you get to about 15%, where 15% of people are churning on a 12-month basis. And In theory, this could make sense as you just get customers get older, they're delighted with the product, they stick with the product, they have all their insurance needs met by Lemonade. So in theory, they should be changing less. The actual number of people churning should be less and less in the long term. So that's kind of how I projected that out. And then my sales and marketing from that is just a function of what's your cost per customer on a churn customer basis, so including the customers that churned away. I mean, when you flip back here, I had that number, customers with churn. If you look at that average, it was average of $183 over the last few years. So I stuck with $200 per customer. Obviously, if you looked at just customers that are just fighting in only auto insurance markets, they only sold auto insurance, this number I think would be quite a bit higher. But because they're competing with, they have all these different avenues, different products. They'll probably have other more niche products they could also have in the future. Because of all those different products, they're sort of funneling or sort of on-ramps for a customer. Then I think $200 is not unreasonable to expect for an acquisition cost. So that's kind of what I've used going all the way to 2030, $200 a customer to purchase a customer through marketing. And then from that, just based on the number of customers you're getting, plus the customers you're making up through churn, you get your sales and marketing expenses going forward. Then I have here other insurance expenses, which I wasn't exactly sure what that was, but I had some people help me out on Twitter. And the best answer I got here was other insurance expense consists primarily of amortization of commission costs and premium taxes incurred on the successful acquisition of business underwritten on a direct basis, and credit card processing fees not charged to our customers. Other insurance expense also includes employee compensation, including stock-based compensation and benefits of our underwriting teams, as well as allocated occupancy costs and related overhead based on headcount. Other insurance expenses offset by a portion of ceded commission income, which represents reimbursement of successful acquisition costs related to the underlying policies. So I got to admit, I wasn't really sure how, we have so many, a slew of different possible expenses there under other insurance expenses. I wasn't exactly sure how to forecast that going forward. But I used 10% quarter over quarter, which is a pretty big jump, actually, just going sort of indefinitely into the future. That's 46% per year. So I just used that all the way going forward. Maybe that's too low, maybe that's too high. But that's what I used for other insurance expense going forward into the future. Technology and development. That rapidly increased over the last couple of years. We're at 3.5 million a couple of years ago. Now we're at 16.9 million, especially as Lemonade Car was being developed. So I'm assuming, with Lemonade Car, most of their products are going to be in place, and they're going to be continuing to refine those products, make them better and better and better. And also, I'm sure have some other products they are developing. So as they grow, I expect that expense is still going to be there, but I don't expect it, or wouldn't think it would continue to grow like it has in the last couple of years. So I just kept that as 17 million per quarter going all the way forward to 2030. Again, that could be, maybe there's some big jumps for certain special projects or developments that occur. Maybe it even goes lower than that, as there's no need to refine things as much, or the system is sort of built and in place. But I thought that was an okay assumption to make. Then general administrative expenses, I kept it growing at about 5% per quarter. Again, this is a huge one. If this was Joe's at 10% per quarter, it's going to be a much different story for Lemonade, or have a big impact at least on Lemonade. But I took 5% per quarter, and again, 5% on an annualized basis, you're about 22%. On an annualized basis. Maybe that's too low. As I think about it right now, maybe that should be a little bit higher. But on the other hand, too, in theory, they should have this is really where your operating leverage comes in. And as Lemonade rolls out more products that are more big ticket products, especially like Lemonade Car, in theory, your in-force premium and all your premiums and your revenue should grow much, much faster than your administration expenses, your general administration expenses. So that's at least one projection what I've done right now. Then you get your total operating expenses, just the sum again of all your operating expenses. And then looking at here, I also have the cash on hand of $950 million next quarter after quarterly losses, and your cash requirement of your in-force premium. So this number really has to be higher than this, otherwise they're going to be in trouble or be needing to raise money. And so then we sort of just start projecting that forward into the future, right? We start rolling that forward, and really gets interesting is, let's see here, the end of 2024, I think could be quite interesting. So 2023, we look at operating income here. They said, Daniel said on one of the recent calls that they expected later this year to have kind of peak losses. So you're looking at, this model kind of fits that. You're at about 70 million, 60 million, 70 million, 70 million, maybe next year too, it's 78 million, 70 million. Could be some rough waters ahead for the next 2022, 23 if this isn't all accurate. And they're continuing to bleed money, so that's a little bit scary of a picture to look at, right? While your in-force premium is actually growing, so your cash requirement continues to grow. But it starts to get quite interesting. We're actually by 2024, or the end of 2023, so kind of the end of next year, sort of, a year and a half from now, is the losses start to drop. Losses start to lower, and then they actually start to diminish further and further. Your cash, the rate that your cash is burning, of course, starts to slow down as well. Your cash requirement continues to increase because your in-force premium continues to increase. And you get to this point right around here, sort of early 2025 and end of 2024, where they may need to raise money. It certainly is possible, but that Lemonade might need to raise some money around this point, the end of 2024, early 2025. Good thing is here is that their operating income, hopefully by then, is showing signs that it is trending positive, in a positive direction, where the operating losses are diminishing. So hopefully this stock can be in a better place by that time. So it'll be easier for them to raise some capital, raise some money, to make it through to becoming fully profitable, because they're going to need not a ton of money, because their actual operating losses aren't going to be huge. Really, like, they're at this point, they're losing maybe 30 million a quarter, 19 million a quarter, 10 million, and suddenly they could flip the switch later that year, 2025. So hopefully the market could see that coming and reward the stock for that. Then they could be at operating income, or have a positive operating income maybe later in 2025. I think is certainly possible. Maybe they get a bump of cash in here, right? Maybe they get a few $100 million that they raise or something like that, or somewhere in this point, somewhere around here, so that they get above this threshold that they're going to meet. So that you can see the difference here. They're a couple $100 million short, couple $100 million short, couple $100 million short. So maybe they're going to raise like $300-400 million at that point. Not sure. That certainly might happen. And then moving forward, though, once they start becoming profitable, the story really changes. I started putting in some income tax in here, and then getting a net income there. And then moving forward, though, you just keep rolling all these projections forward, and you look at their operating income. Let's look at that number and look at this operating income number here. Highlight that. You go all the way forward, and you're looking at, by 2030, they could be making $500-600 million per quarter in operating income. They might possibly could have billions of dollars in cash. So maybe around this time, they would start phasing out their reinsurance possibly. They might have less need for reinsurance, or they even grow the top line numbers even more aggressively than I've shown. They spend even more on marketing so that their top line numbers or top line customer growth is growing even more rapidly. I could see them probably doing that before they would cut reinsurance. But that gets projected out. So there you get, again, 600 some million per quarter. On an annualized basis, you're talking maybe $2.3 billion. And you take out some money for taxes. After tax, you're talking, you're talking $1.8 billion on a yearly basis by 2030. And then you think about if a company like this by 2030, if they're still growing, 8% a quarter in customers, which is still significant customer growth, and even if their premium per customer is kind of steady, but your in-force premium is still growing, from 19 billion to 26 billion, still like a 30-some% growth in in-force premium, huge growth. I feel like the market's going to reward a company like that pretty aggressively still. So I've given them then a price to in-force premium ratio of 2, which would put them at, maybe in the $40-50 billion market cap range. So I forget what Lemonade's market cap is actually right now. Just check that. So, just barely over $1 billion right now. So we're talking like a 40-50x by 2030 is, I don't know if it, maybe not impossible is really what I'm saying. They could be $40-50 billion company if this pans out correctly. And then another way to look at it too is you look at a PE on an annualized basis. So just annualizing on multiplying this net income by 4, and then giving them a PE of, say the market gives them a PE of 30, then you're still kind of in a similar range. So there's obviously lots of assumptions built into this whole spreadsheet. Again, there's lots of things that could go one way or the other, and this is obviously, I'm a Lemonade bull, so this is slanted to the bull scenario, but I don't think it's insane. It's certainly reasonable if they execute, if they are successful. You could have massive possible returns between now and 2030 in the next 8 years. Of course, maybe I'm way too optimistic, and maybe their general and administrative expenses grow way higher than this. Maybe the market, there's a huge recession in the next few years. It's really hard to raise money, and maybe Lemonade goes bankrupt. Around that time, I was saying they may need to raise money, like the end of 2024. Certainly, in 2.5 years from now, certainly possible, and certainly a major risk, but there's still huge, tremendous upside. And so for me, my strategy, I'm just adding shares slowly to my portfolio, bit by bit, adding little bits here to it, and watching it very closely, because I think even if the stock performs, say, well, even if the recession's kind of over and things are looking brighter as a whole, and by the end of 2024, even if they do raise some money, they do okay at that, and the stocks had a big jump already by then, I still think if they kind of reach that point and you see the writing on the wall that they are trending towards profitability and are going to continue growing and customers love the product, then I still think there'll probably still be huge, massive upside from this point, going forward. Like if you looked at a 30 PE there, maybe by 2027 you're at a $14 billion market cap, and you might say, wow, you might feel like even at that point in time, if you hadn't been investing in Lemonade or hadn't gone all in, but had only been slowly investing, you might think, oh man, did I miss the boat? But really, maybe it's only at 14 billion and it's going to go to, 50, 60 billion in just a few short years. So I still think there could be huge opportunity, even a few years from now, still huge opportunity. So that's why, for me, I'm kind of conservatively adding to it and watching. Obviously, if I know it's going to be successful, I want to be in as soon as I can. So that just about does it for this video. Make sure to subscribe if you got value out of it. Leave a comment down below, anything you noticed or thought could have been better or you would change the projection. Please let me know down below. Any feedback whatsoever, positive or negative, I really appreciate that. You can also find me on Twitter at PaperBagInvest. Hope you liked this long form video. And remember, it's in the bag.